Hey everyone, welcome back to another Explainer. Today, we're cutting straight through all that daily market noise to unpack the actual mechanics of equity valuation. We're going to break down the hard math of intrinsic value versus market price and look at the data-driven frameworks that separate the truly successful investors from the rest of the herd. Take a look at this setup. It's kind of the ultimate market conundrum, right? You've got two companies generating the exact same profit today, but they command vastly different share prices. Why on earth would that happen? Well, because the market isn't just pricing in today's reality, it's pricing in tomorrow's expectations. A stagnant trajectory gets discounted pretty heavily, while future growth gets a massive premium. So to figure all this out, here's our game plan for today's Explainer. We'll start with the basics of equity, contrast market price with intrinsic value, learn how to calculate that intrinsic value, build an investor decision matrix, and finally, prove all of this with hard data. All right, let's jump right into part one, the basics of equity. At its core, the equity market is really just a massive marketplace for corporate ownership. When you buy a share, you aren't just trading some random ticker symbol bouncing around on a screen. You're securing a legal, fractional claim on the underlying assets and the future cash flows of massive titans like Apple, Amazon, or Nvidia. And as a part owner, that fractional slice delivers wealth to you through three main pillars. You've got income, usually hitting your account as dividend payouts. You've got growth, which comes from the company aggressively reinvesting its profits. And then, of course, capital gain, which happens when the market starts valuing those expanding operations at a much higher premium. Moving right along to Section 2, market price versus intrinsic value. So, investing is really just this huge, ongoing balancing act between two totally different concepts. On one side of the scale, you have the market price. That's simply the current price tag dictated by the crowd, and it's constantly swayed by daily news, wild emotions, and whatever the latest trend is. But on the other side, that's intrinsic value. That is the actual underlying economic reality of the business. The greatest investors out there literally make their fortunes by exploiting the exact moments when these two things are wildly out of balance. Think about it like this. If the market slaps, say, a 150-pound price tag on a share, but you do your homework and your financial analysis reveals its true intrinsic value is actually 180 pounds, well, that $30 difference, that is your undervalued margin. Finding that margin of safety is absolutely crucial. In fact, it's the entire objective of value investing. Which brings us to the obvious follow-up in Section 3, calculating intrinsic value. Okay, so how do we actually find that magic number? Well, intrinsic value is all about looking forward. It requires you to estimate every single future dollar a company is going to generate and then funnel all of that back to present-day terms. We do this using a process called discounted cash flow, or DCF. You project out the cash flows, apply a specific discount rate, and boom, you arrive at the true economic value of the firm. But wait, why do we have to discount those cash flows in the first place? It all comes down to the time value of money. You guys know the drill. Inflation constantly eats away at purchasing power. There's the opportunity cost of what else you could be doing with that cash right now, plus all the inherent risks of the unknown future. Basically, a dollar tomorrow is mathematically worth less than a dollar sitting in your hand today. So a promised 300 pounds spread out over the next 3 years absolutely must be discounted to reflect its true present value. All right, let's put all this theoretical math to work in Section 4, the investor decision matrix. When you stack up your intrinsic valuation against the current market price, you get this incredibly clean, totally objective diagnostic framework. It's beautifully simple. If your intrinsic value is greater than the market price, you buy. If they're equal, you hold. And if the market has hyped the stock way past its actual intrinsic worth, you sell. It completely removes the emotion from the process and anchors your portfolio directly to the math. Let's back this all up in Section 5, proving value with data. To really prove these valuation theories aren't just academic fluff, we rely on correlation. It's a metric that ranges from -1 to +1, measuring exactly how strongly and in what direction two variables move together. But remember the golden rule of statistics here. Correlation helps us predict patterns for sure, but it absolutely does not imply causation. When you map out real financial metrics, the visual patterns are impossible to miss. See a really tight upward-sloping cluster? That indicates a strong positive correlation, meaning as revenue climbs, the share price climbs right along with it. On the flip side, if the data looks like a totally random scatter, that reveals zero correlation. Our goal as investors is to map the real market data to see which of these patterns actually materializes. So let's apply this directly to the heavyweights, the Magnificent Seven tech giants: Apple, Nvidia, Microsoft, Alphabet, Amazon, Meta, and Tesla. We want to figure out, are their massive astronomical valuations actually anchored to foundational financial performance, or are they just floating away on a giant cloud of market enthusiasm? Here's where you get to play financial detective. Try running these 3 steps on that specific group of companies. First, test the correlation between their share price and their sales revenue. Next, test the share price against their earnings per share. And finally, hunt for the outliers, because you might just find a tech giant where revenue growth is completely detached from its booming stock price, which is a massive red flag for pure market hype. And I'm going to leave you with this final kind of provocative thought to chew on for your own portfolios. When the market is pricing these absolute tech titans, does it actually care more about top-line sales revenue or bottom-line earnings? And does that answer completely flip depending on whether a company is viewed as a steady value play versus an explosive growth stock? Let the data guide your investments, guys. Thanks for tuning into this explainer, and keep hunting for those margins of value.